August 6, 2022. Nathan from Queens, Ultimate Traders on Reddit. So this is video 2 again. So I'm a little sorry about video 1. I know it's going to be controversial. Everyone likes AMC. Well, not everyone, but I would say a majority of retail. But at least with that you know that I'm not here for likes. I'm just here giving you information. So if you want to hate me, hate me. I'm just telling you the facts. And whether you appreciate that later on, who knows? Maybe you don't. Maybe if you were in ADR or BBIG, be big, and you got out, you appreciate it now. You are going to, not that you're going to appreciate the GameStop AMC, but you're going to go back and be like, you know what? He was right. I don't even care if you say I was right. I just try to do the facts. So video 2, I like to do 3 videos normally when I do videos. I'm not an entertainer, so I'm not going to do this every day. I've been trading since I was a little kid. My whole point of going into trading was to buy cars. I've had over 40 cars before I was 40, so it was a big waste of money. It's not something to brag about, but I'm just trying to say I got into this for cars, and I got cars. I got other stuff as well now. I don't own 40 cars now, but I've been through a whole ton of cars because when I was a kid, I was really dumb. I was buying 2 or 3 different cars a year, which was dumb because it just depreciates, but it is what it is. So video 2 is the state of the market. So everything that I said that was going to happen back in February, March, even a couple months ago is happening. The only thing is the stock market is doing things a lot different from what I feel that it's supposed to. So back in February, with the war and gas prices starting to go high, I was trying to say the gas prices is an indicator that we're going to go into a recession. Now that recession has been confirmed on July 28, 2022, 2 consecutive quarters of negative GDP. There it was. I said it was going to happen. I was saying that earnings are going to be between 60 and 65 on my grading scale. Now I'm going to go into that also. Now I'm just saying about the recession thing. Now this is going to be a lot different recession that we've never seen because we had close to $5 trillion being pumped into the economy. We had a COVID situation. We had shutdowns in China even recently. We might even have a war with China. It is pretty serious. We might try to say it's not, but it's pretty serious because we're interfering and doing things that China's telling us not to do, and we're doing it. Like Nancy Pelosi went into Taiwan, even though Taiwan warned us. So it is what it is. But I'm just trying to say it's fairly serious. And this recession is going to be a lot different because we're paying people to stay at home. There were a lot of shutdowns, so obviously we do need jobs. Unemployment is at a historic low, 3.5, 3.6%. And generally, when we're in a recession, unemployment is 5 or 6%. So the way the economy works, and I wrote about it in post before, normal inflation is 2%. GDP is 3%. And inflation is 3 to 5%. Keep that in your mind. So if we're going 5 years from now, 7 years from now, 10 years from now, that is what we want. This is what is safe for the economy. 2% inflation, 3 to 5% interest, and close to 5% interest. So when we have close to 5% unemployment, so when any of these numbers are off, it means that things can happen. And normally, like I said, with a recession, unemployment rate is higher. It's very rare that we're in a recession. So this is a recession. It's a slowdown, but it looks a lot different. Now, yesterday, August 5th, around 4:15 or 4:20 on CNBC, they had someone on CNBC Overtime. I watched CNBC Overtime. I don't even recall the guy's name. I have seen him once or twice before, but brilliant. This is how he describes, because he's also saying we're in a recession, but it's a different recession because we have so much money pumped in. We had so many shutdowns. It's going to look a lot different. He was saying for the low income people, This is a serious recession, even depression. So people that get below $35,000 a year in household income are seeing this as a recession depression. Middle income people, household near 60,000, they're seeing it as a mild recession. So they're adjusting. They're adjusting the way they live. People that have household income of 60 to 100,000, which is like a upper middle class, not upper class, but upper middle class, are not really seeing the recession. They might be changing their habits slightly. Like instead of going out to eat 3 or 4 times a week, they're eating out 2 or 3 times. The poor, the lower income person is instead of getting milk or orange juice, they're getting canned cranberry juice, something like that. That's just an example. Or instead of getting oatmeal or waffles, they're eating cereal. So it's a major recession depression. The middle income person, same thing. Like I said, with the movies or with eating out, they're eating out less. The person that's lower income is changing their life drastically. So right now we're in a mild recession. I don't know if it's going to be, and I don't even know. They keep saying soft landing and hard landing. I'm not even sure if there's an actual definition. An actual definition to me is like 6 to 8 quarters, a hard landing, 6 to 8 quarters of negative GDP. That's like that's like a depression. So since it's not defined, I don't know what they're defining as a soft landing or hard landing. Can someone define it just like I try to define earnings? Now I'm going back into earnings because I'm watching CNBC. I don't really understand why they're saying that earnings are good so far. Earnings are not good. Now this is what I'm trying to say. So if a company is supposed to meet bottom line and they met bottom line, are they on CNBC calling that as good earnings? See, to me, they must meet top and bottom. Top and bottom. They can't just meet bottom because it's easy. We only have 2 numbers, sales and bottom line. If you meet bottom but miss top, you failed. And if you meet top and bottom by less than 3%, that's not a good report. That's like a 65, 70. I can't, because you were supposed to make $1. You were supposed to sell 100 million. Let's say you made $1.01. So you beat by 1%. And instead of selling 100 million, you sold 102 million. So 2% on top line and 1% on bottom line. I can't say that was a very good report. I give it a 65. If the people on CNBC, because it's not defined, that's why I came out with my own grading scale, because you guys can see it and you guys can tell if something is good earnings. So are they trying, because I'm saying I don't know, are they trying to say if a company only met the bottom line, that's good earnings? That is not good earnings. I'm sorry, but like I said, they are saying it on CNBC. Some people are saying the earnings are not good, but they're not as bad. To me, if something is not as bad, that is not a reason to buy a stock. I still don't buy a stock because, earnings were bad, but hey, they weren't as bad. That's just like I wrote on a post. So that's like me going into a test. Okay, I was thinking on the test, I was going to get a 60, which is failing. But I got a 63. So I still failed, but I got higher than what I thought I was going to get. That's still a fail. Like, to me, that's still a fail. So with that, what I'm trying to say is earnings are not good. They're not bad. They're not bad. So I'm not saying that these companies are getting 50s. Right now, the safe trading range on the NASDAQ is 9,500 to 10,500. Obviously, we're like 12,700. A safe range on the S&P is 3,300 to 3,600. Obviously, we are higher. Now, since the S&P is 500 stocks that kind of depict the economy, everyone goes and looks at S&P 500. Over a long period of time, the S&P trades normally at like 18, close to 18 times earnings. Post-pandemic with the apes, it traded close to 30, not 30, but close. I think 26, 27 was the peak on the S&P. Obviously, if history was saying the S&P was trading at 17, 18, and we were trading close to 30, the S&P was way too high. And I'm saying that because right now, the S&P is back towards 18. And the E in the PE is slowly going down. But once again, like I said, I'm not saying earnings are bad, but they are just missing. If earnings were bad, I would say NASDAQ definitely 9,500, S&P definitely 3,300. Now, a safe range doesn't mean that the NASDAQ is going to fall to 10,500, 9,500, 10,500. That's my safe trading range. Right now, the NASDAQ's at 12,700. I'm not trading too much, and I'm going to do that in video 3 because I'm prepared for a rug pull. A daily crash on the index of 3%. If an index, S&P or the NASDAQ or the Dow fall 3%, that's what I call a daily crash. I don't know if other people define, but to me, definition is 3% on a single day is a daily crash, not a crash in the market. So crash in the market in the index is 40%. Bear market is 20%. Recession on an index is 30. A crash is 40% or more in an index. So I'm not saying that the NASDAQ or the S&P is going to crash. Earnings aren't bad, but they're not good. They're just barely getting by. But I'm going to say because this quarter and because the inflation is still high, that the third quarter, which has the third week of October, that third quarter earnings end September 30th, are going to be this level or worse. And we're going up. So if the S&P normally trades at 18 times, 17, 18 times, we're already at 17 or 18 times. What is the upside? What is the upside? Do you see the S&P going higher? What is the upside? We're already there. And if earnings goes down, the multiple contracts. The multiple contracts. And we're already there at 4,200. So we're not leaving any upside if we're already there. So people are trading this and we're already there. So I don't understand. You know, I wish the analysts or the people on CNBC would just tell me that if a company meets earnings, it's not a 65, it's 100. Because if they're on TV saying earnings are good and they're not good, it's creating FOMO. It's making everyone feel things are safe. So the market was up because they're thinking that in a recession that Powell is not going to raise rates. Or they see oil going down, which does mean that inflation is going to come down, and a recession does mean that inflation is going to go down. But as I said earlier on in this video, normal inflation is 2%. What Powell wants is 2% in the long run. So interest rates need to go up a lot, not a little bit. Right now we're at 2.5. I'm saying a lot, like 5%. We need the 5% to stop inflation on its tracks, but he won't do it. So, and if interest rates rise, and I have videos, it will kill your company's earnings. It will bring us into a deeper recession. People will lose jobs, but it's needed. Why? Because the lower income cannot afford rent. The lower income cannot afford food. Majority of people in the United States are lower income. Okay, there's close to 85 million people in the United States, and you can look it up on Google, that have Medicaid. Medicaid is state-funded insurance for people on lower income. So if 20 to 25% of every single person is lower income, and we're not even talking about low income, we're talking about low income. Majority of people on lower income, they must attack inflation. So if we're in a deeper recession, if companies miss, Powell must keep going on at raising rates. Now, Can he change the policy? Anything is possible. But he keeps saying his number one thing is attacking price stability, which is inflation. So if you want to keep attacking price stability, we're going to have to keep going higher in rates. So he said by the end of the year, we're looking at close to 3.5. We're at 2.5 right now. He said sometime next year that rates might be as high as 4%. Now, if you take a look at the Treasury bonds, they're predicting that the Fed will lower rates next year. I do not believe so, because inflation will not go down. Unless rates sky up, inflation will not go down. And because unemployment is historically low and new jobs created yesterday was very high, that should indicate and give you confirmation that Powell has room to raise rates. If rates are raised, it will slow down inflation. It already has, but it will kill company earnings. So we're here doing videos. We're here trading companies. We're not here looking at the people. The people can't afford food. They can't afford rent. And we're worried about stocks going up and down. We're worried about earnings. Obviously, Powell has to worry about the people. Of course, he can keep an eye on the stock market, but if people can't afford rent, people can't afford cars, rates are going higher. So when rates go higher, earnings drop. The state of the market is not good. Inflation is super high. We're going to see CPI rate again on the 10th, this Wednesday, close to 9%. Powell is going to have to raise rates 0.75 again, bringing us towards 3.25, and he might have to keep going higher. You're going to see with the rates. Companies are doing 60 to 65, and the market is up. So if the market wants to keep going up, because the stock market is a daily auction, I want to stay on the sidelines. I'm in like close to 75% cash, and that's because I'm holding bags. 20% of my stocks right now are bags that have had over 30 days. Stuff within 30 days is only like 5%. I'm not trading that much with cash. In video 3, I'm going to go over some of the stuff that I'm trading, some of a bag that I just got, but this is video 2.